Mr. Gupta, on that point of governance safeguards that Mr. Bagga was alluding to, these new rules, whether they are the lock-in rules, whether they are the disclosures, the governance safeguards, you think they balance out the risks that may be there for small investors, or do you think that SEBI has tilted the scales a little bit?
See, let us understand what are the sources of risk in a listed stock. In a listed stock, the biggest risk is market manipulation. The manipulation is possible only when the floating stock is low. Here it is a question, we are saying the floating stock is so big that it is not possible for a company to make the issue. So number of shares that are there are very high. What we have to guard is this: the number of shares should not be distributed into 10 or 20 people that they have whatever is in the public domain, they command 90% of that share and they keep on manipulating. But even if they are doing it, SEBI has got sufficient system to catch that. The risk comes from that. The other risk comes is because if you have got 95% holding, then the special resolution that is passed in the company with a 75% majority loses its relevance. So SEBI will have to work out in such a manner that if you are doing the public float, so whatever is public float should become equal to more than 25%. And the voting power of promoters or founders, whatever it may be, should be balanced in such a way that 3:1 ratio is maintained.
Right.
So that special resolution can be defeated.
So you're saying only if that happens, then this is likely to work in a balanced kind of way. Mr. Bagga, what do you make of that? Often we hear founders arguing that they should not be forced to give up too much equity too soon. But you think retail investors are paying for that kind of comfort that founders are likely to enjoy now?
Look at global companies, there are no promoters. Or within India also, some of the largest institutions, there are no promoters. And they are very well run. They are board-run companies with management appointed by boards. So, this is something that Indian promoters always do, that they hang on to as much as they can for as long as they can. They want the listing. They want to get the currency from the listing. But then they don't want to dilute down, and they will take the regulator to court. They will cite COVID and this and that happening. That makes the retail investor ultimately lose out, because unless your free float is there, that stock will not get into global indices, will not get that ranking. And as market also, we suffer then, because we are very low on free float with respect to our size. We are a top 5 market, but we don't have the free float to really justify. And that's why we don't get our rankings in the global rankings. That's what promoters have to understand, that it's not that either you then stay private, but if you want to come public, you have to have enough free float. And as Mr. Solanki was mentioning, the institutions will not be able to come in because there's a very clear impact cost criteria.
Correct.
And if you have so little of free float, and then you actually see the actual free float, as Mr. Gupta was mentioning, the stock gets cornered by, known hands and informed hands. And then there is hardly any, free float available for mutual funds. The impact cost is too high. The fund manager will not get compliance approvals.
Mr. Gupta wants to come in on that. Mr. Gupta, you were saying?
See, again, I am saying the free float we define in terms of percentage or number of shares.
Which is already happening.
I always say percentage of shares have no meaning for me. Because if you have got a company which has a 10 crore market cap and is 25% or 30% free float, it's 1,000 into 30, 300 crore. If you have a company which has a 1 lakh market cap and it has a 5% free float, it has a 5,000 crore.
Correct.
So the issue is the balance has to be what are the number of shares which are in the market, what is their value, and how they are concentrated. Now, say, for example, if 5% is there, look at the question of LIC.
LIC
is only 5% or less than 5%. And it is concentrated with institutions.
So Mr. Bagga wants to counter on that. Mr. Bagga?
No, I agree with that, sir. But why have regulators globally put a 25% free float. There is science behind it. There is thinking behind it. Irrespective of the size, they prefer a 25%. That is the norm. If you look at the top 30, 40 exchanges around the world. So it is a norm that has come in. It's not meant, because see, I'll tell you very clearly, if I'm a big fund manager and I want a sizable position and I want to put in $200 million, I can't put in. That it becomes as simple as that. While if it's a 10 lakh crore share and it has a 40% free float, my impact cost goes down. I will not get compliance clearance only. That 2.5 will become an issue. It's not that simple, sir. And that's why everybody is going to 25%.
So 25% as a global standard, you're saying that what works globally perhaps may not be working over here. Mr. Gupta, what are you saying to that?
I'm again saying, Mr. Bagga has said that in America there is no concept of promoter. So everything is free float. In India, the issue is, again, I'm saying, when a mutual fund or LIC or insurance company invest, they invest on the amount. Nobody says that I want to have a 5% pie in this company or 2% pie in this company. Now, my amount is so big. Say, for example, if a company which is a 10 lakh crore market cap,
yes,
I don't think LIC would want to own 10% of that because it will be 1 lakh crore.
Right.
So LIC will still want to have 10,000 crore, 5,000 crore. So again, I'm saying it is the number of shares which are available and the market cap. It has nothing to do with percentage. The only thing to do with percentage is ensuring that special resolution passage is possible only with the support of public. Similarly, related party issue, similarly, protection of minority. We got to take care of all those issues from where the governance can be diluted. And if you handle that, there is no problem.